Take that. Okay. Now I need to new video. Make sure it's not blurred. There you go. Just make it full screen just so we can make sure that. Does it say it's being recorded? Yeah, okay. Cool. Do you want to pin this? I'll stand here. And they see. Good. Is that good? Yeah, I think so. Let me get these. Yeah. Go slowly. Yeah. Thank God. 11:30. 11:30 to 12:30. It's over. Wait, at night? No, like 11:30 to 12:30. Why is it that late? It just you need like extra time to get all the piano and it's supposed to go bed, so you have to go into the night. You can go out after 12:30. Yeah. If you're a real trooper, you will. You order burritos? Nah, not bro. Oh, we have to need it. What? I know I'm above one step. Oh, it's, I mean, it's not gonna be crazy compared to last year, but yeah. How was the chase? Oh, or the Charles, you didn't race. Yeah, I'm not bad. Well, it sounded like everyone, it wasn't too bad. I know I'm not that happy. So. Nick was like happy, he's like 173 or something. I was like, yeah, bro. I heard you're both in well together. Yeah, it's also base. Yeah, I'm excited. Hopefully it stays that way. You're very like flip-floppy, so I think you gotta get everybody. That's amazing. I think we all felt the power. Yeah, we were like 205 and flopping, and then we got to like 155, and it was like smooth. That's like, yeah, man. Okay, yeah. We'll see how long it will be. Yeah, I'm excited to watch it. Yeah. Is Luke gonna do the? I think so. I think he's back to better than that. Okay. So I'm probably gonna involve in that. But whatever. And my friend did it there. Yeah. Oh, DM tonight? DM tonight. There's so much first year event at 8:30 right now. Oh, it is already. Oh yes, I remember someone telling me that. Yeah. Oh yeah. Fire. A lot of people told me they couldn't make it. No, it's like FY first year. Oh my God. Yeah, we'll wait like this. I might want my friend or I might go to Wi-Fi. And the editing always like crazy. Yeah, but you have to go. Maybe more high. Yeah. Maybe the World Cup our senior year. World Cup freshman year was pretty good. Yeah. I remember I left my Disney picture and I didn't even check my workers. I didn't even know, and I got to go on the last 30 minutes. I watched it. Yeah, first. I watched it pretty good. It was busy because I remember arguing with my friend about one of the momentum questions. And I was like, no, it's an inelastic collision. Like, I don't know, yeah, last like 10 minutes. And that's so aside. Oh shit. All right, we're gonna get started. Today will be a bit of a chiller lecture. We only have like 55, 60 slides instead of our usual. Something like that. So yeah, we're gonna take it slower, leave a lot more time for questions. Remember, there's the live Q&A link that's anonymous as well at bli.bo/qsig. And yeah, today's lecture is going to be going over fundamental equity strategies. And what that means is it's kind of like we alluded to last week, it's the bread and butter of most hedge fund strategies. They're long companies that are good and short companies that are bad in simplest terms. We'll go over a couple flavors of this, including activism strategies. And then after that, we'll get into a couple of the academic debates about, what is the market efficiency hypothesis, what does reality actually look like, how different are those two ideas. Also talk about some factors. So we've mentioned before you have beta. Does anyone remember what beta is by any chance? Like the stock has a beta. Yeah. What is it?
How correlated you are to something.
Exactly. So if you have a beta of 1, that means for every dollar the stock market moves up, your investment will move up 1 as well. Beta of -1 means you'll move down when the stock market goes up. You can also have betas to these things called factors, and we'll get into what that means. And then also, how do you evaluate a hedge fund? And this is important if you're like going to work for a hedge fund. Maybe you're curious about how they've been performing. Are they growing? Are they stagnant? And we had done a little bit of this last week, but we'll continue some of that today. Also, a lot of people requested homeworks. I spent probably too much time over the weekend working on making those. So I'll send a couple of them out and get some feedback and then decide whether you guys want more or not, whether I should spend more time on it or not. Okay, so the first thing is, what is a good company? And I guess probably the question that if I was sitting in your shoes would be like, why do I care what you think a good company is? This is T6 performance over the past 5 months, I want to say. Yeah, 5 months. We've been doing pretty good. So we're not experts. And this is not to like say that we're experts, we know what we're doing. To be honest, no one really knows what they're doing. And if you really believe in the words of like the great people, like these are probably some really good resources and stuff that I consume pretty regularly. Warren Buffett's shareholder letters, Howard Marks, who runs Oaktree or who started Oaktree Capital Management, he has memos on his website. Also Demoradon, he does videos and valuation, and he talks a lot about markets and stuff. And there's a couple books. Bottom line from like all of these is like you have to analyze and go deep on a company to truly understand it. Bring into a bit of what that means today. So these are a couple of excerpts from those resources that I mentioned that I think are pretty relevant. So this is a quote that Charlie said to Warren, and Warren quoted after Charlie, who was his like number 2 guy, died. He said, it's better to acquire, in essence, wonderful businesses at fair prices and give up buying fair businesses at wonderful prices. So what this is saying is you should really be focusing on the quality of the business, not necessarily the price. And Warren Buffett always says you're buying a business, not a stock. So you should be really looking at the underlying company. So what they really look at is good returns on capital, run by able and honest managers,
and at a sensible price. So we'll go into what each of these things means. You can see that Warren Buffett has annualized, Berkshire Hathaway's annualized around 20% returns up until 2023, which is 4.4 million % returns compounded. So they're pretty successful, obviously. And so I guess his strategy, if you had to summarize in a couple of points, is look at time-tested companies with stable cash flows. Famously says he doesn't really invest in any new companies, and when he talks about his investments in, I don't know, American Express or Coca-Cola, those are all companies that have been there since like the 1850s, right? They're really old, they have proven markets, and they're able to go global with those. He also references these things called large economic moats. And what that means is competitive advantage that they have over their competitors, and that means that they're not very exposed to a new firm coming and taking up a significant portion of the market share. He also is considered a deep value investor. He's not always focused on growth or what's going to be the next big thing. He just wants really good companies that are going to grow, maybe at the rate of the economy, maybe more, but that are just really solid companies. And unique to Warren Buffett, and especially nowadays with as you remember from the first lecture, we showed you the average holding period of a stock has kind of come down a lot. Warren Buffett typically will buy his investments and hold them for like 80 years, as he's been doing with like Geico and some insurance companies, but generally greater than 10 years. He also is very fiscally conservative. He doesn't use leverage. And you're probably wondering, why am I talking about Warren Buffett? And I'll get into why. But this is another thing from the guy who runs something like that, Howard Marks. He emphasizes this level of thinking called second level thinking. So it means instead of just thinking, oh, this company is good, so its stock price will go up, ask all of these other questions and try and analyze that. And he says that in order to get market beating returns, which is the goal of any active managed fund, you have to depart from the pack. You have to be contrarian. But being right doesn't necessarily mean you will beat the market, right? You have to be more right than other people who are also trying to be right. So in this table, you can see like the goal is to get above average results. And so you want to be right and favorable outcomes, and you want to be different from everyone else, unconventional behavior. So do people actually believe in this? Do people actually follow the word of Warren Buffett and Howard Marks? These are real quotes from fund presentations that we looked at this summer. And you can see a lot of those ideas are kind of there. Initiate these trades with a margin of safety. Look at it through the lens of a private equity investor. Imagine you're buying the whole business and you're not just buying the stock. Look at the value, or GARP. GARP stands for growth at a reasonable price. So a lot of these funds have the same methodology, but they're also really vague, right? Like, what do these words mean? What does it mean to be a value investor? What does a margin of safety mean? How do you actually do this? And how do you build the intuition to become a good investor? So at TSIG, we've kind of looked at these 7 things, and I'd say generally most of our investments fall into or satisfy these 7 criteria. And we'll go into each of these in a bit more detail. So the first is competitive moats. Companies with huge competitive moats means, like I had mentioned, they have a really large market dominance and they have network effects. So for example, once you start using MasterCard or once you start using the Apple ecosystem, it's really hard to switch away from it, right? Most of us have Macs, let's say. You know that an iPhone seamlessly integrates with your Mac. If you bought an Android phone, it probably doesn't. So they have a lot of this cross-selling ability. Large portion of the world's financial transactions are moving to digital. MasterCard has built this huge infrastructure. Visa, Amex, they have these huge infrastructure platforms that you really can't beat if you're a new company. On the other hand, in the case of solar, there's like a lot of people who say you'll never make money selling solar panels because the marginal, they don't have huge amounts, right? Most people with a modest amount of capital can set up a solar manufacturing plant. And as long as theirs is competitive, they can encroach on your margins and start taking away some of your market share. It's a very competitive industry, solar. Can anyone think of any other industries that are either really large competitive moats, any other companies, or something that's kind of meh in terms of their economic mode?
Commodities and
What do you mean by commodities?
like solar panels, concrete.
Well, yeah, except
Where the pipe play.
yeah, because there are economies of scale, right? Like if you're a really large steel manufacturer, like US Steel or Nippon Steel.
Yeah, vertically integrated.
Yeah. Yeah, so most of the Magnificent Seven, they enjoy these really large moats, right? Like everyone uses Google as a dominant search engine. No one really uses Yahoo or Bing. And so they have this huge moat. They're able to really cross-sell like ad revenue and all this other stuff. Other companies are like Amazon. They have this huge distributional supply chain system where you can get a package delivered to your door in under a day. And that's a really impossible thing for any other company to recreate, including like our USPS or FedEx, right? They can't really compete with it. And some of them are even turning to Amazon to deliver their packages for them. But
It's important to note votes are not stationary, right?
Yeah.
So in the case of Google, you could say for the first time in its existence, it's come under threat from, OpenAI. That's why they're spending billions and billions of dollars into developing their own capabilities. And management's actually back on the front line trying to build up products, right?
Yeah.
A good counter examples would be Kodak or BlackBerries that were once dominant players in their industry are virtually non-existent today.
And so the emphasis there is you have to innovate. When something changes, there's a famous quote of, I think his name's Steve Ballmer, the guy who used to run Microsoft, where he's talking about Apple and he's like, oh, it's such a joke. Like, why would I want this tiny keyboard on like my screen? And like, obviously he regrets the decision of not getting to the smartphone industry, and Microsoft doesn't even have a smartphone platform today. So the second is growing markets. And I guess the most clear example of this is probably AI and NVIDIA. And the thing here is that it's really easy to get caught up in the hype, right? Where these huge projections, these huge growth rates, you have to be disciplined in making sure that you're actually evaluating the investment logically. And there's also these things called sunset markets. You might think like coal mining probably was very profitable back in the day. Now there's not much drive, there's not much infrastructure spend, there's not much interest in developing more coal mines, especially in areas that are transitioning, such as the United States. Unit economics refers to how much you can make from a customer over the course of their lifetime. So there's two ratios here, like the customer acquisition cost or the CAC. That refers to how much do you spend on marketing and on sales efforts to get the customer in your door. The second is the lifetime value of the customer. How much is that customer going to shop with you, spend with you? In the case of Netflix, are they paying your subscription for how long is the average term of that subscription? And so for growing companies, it's really important to think about what happens as these two numbers change. If your lifetime value of a customer is less than the customer acquisition cost, that means that if you pay, and in the case of Wayfair, and this is actually a case study I had to complete for an interview, here you can see that their customer acquisition cost was $69 to acquire one new customer, but their total lifetime future value of profits was only $59. So they were losing $10 for every customer that walked in the door. And what that means is that growth is actually bad for that company, right? Every time they grow, they're losing $10. And of course, these numbers aren't stationary, right? Maybe their lifetime value of a customer grows over time. And this is just one report, but that's why unit economics are really important, especially in the context of growing companies. Yeah.
If you go back to the graph really quick,
Mhm.
is there any sort of like generalizability behind like the sort of decreasing or increasing slope of like the customer acquisition cost, and why is it?
Oh, why is it like a parabola?
Yeah, why is it positive?
It's a good question. Well, acquisition only happens here. So maybe you're doing a lot of like broad spending on like Instagram ads or something, and then maybe you have more niche targeting. I actually don't know, it's not my graph, but maybe you have more niche targeting where like you have a sales rep calling customers, right? And so as they come deeper into your sales funnel, you're spending more and more to get them to the acquisition point. Maybe that's some situation, I'm not too sure. Another thing is, we look at things that are misunderstood or underappreciated. So the market is notorious for getting things wrong, like the .com bubble. There's a lot of examples of where people underestimated the potential of some new technology. And so if you can find an idea that's misunderstood, and one thing we always look at is like there's these huge conglomerates that spend a lot on R&D on these new technologies. For example, Occidental Petroleum is this huge oil and shale and gas company in the United States, but they're also a leader in carbon capture. So maybe today carbon capture only represents 2% of their revenue, but over time that'll grow to 50% of their revenue. And if you can see that trend before other people can, that's inherently contrarian. So that's the whole thesis that we have with TSIG is we know that the energy transition is happening, and we think it's going to happen at a pace far more rapid than what other people expect. And that's why we think it's the most attractive investment opportunity. And the last thing here is this term called GARP. And so generally, like, low risk stocks that are trading at low multiples are called value stocks. High risk stocks that are trading at high multiples are called growth stocks. There's this whole middle tier called GARP, and that's growth at a reasonable price. So it's kind of a hybrid between value and GARP or in growth. And so I want someone to guess where on this pyramid these names would fall. These stocks. So this is, I'll read it out: Tesla, Roku, which is like the TV thing, Coinbase, crypto, Roblox, game, Palantir, which is like defense, technology, data, AI, Square, Block, which I think is Square, which is like a payment platform, and Robinhood, which is a retail brokerage that most people have probably heard of. You think it's value or growth? I guess let's put in those two names.
I think Tesla's definitely growth. I feel like so is Coinbase and maybe Robinhood.
Yeah.
Um,
Yeah, no, that makes sense. So I guess maybe I should have defined what value is. Value is typically like companies that trade at really low PE multiples. So that's price per earnings. And they're generally very solid companies that might not have a huge growth potential. Coca-Cola, I don't know if I consider that value, but like utilities, auto manufacturers, US Steel, those might be considered value. Like they're typically unsexy, boring investments. Growth is like the hot button, like crypto, all that kind of stuff would fall under there. And so there's a whole ETF. Remember how we talked about ETFs and how you can take all of these factors such as growth, momentum, and turn it into an ETF. This is a famous one. It's called ARK-K. It's the Innovation Growth ETF run by a woman named Kathy Wood. And you can see that in the bull market of 2020, 2021, where every growth stock was kind of going crazy, this ETF did very well. And the second the Fed raises rates, the growth bubble pops, it performs really poorly. Even now, over a 10-year period, well, maybe if you got out at the peak, you would have been doing fine, but over time, you actually would have been worse had you invested in that versus the S&P 500. So what this means is that growth can be really high risk, really high reward, but it's also very sensitive to macroeconomic conditions. When the Fed raises interest rates, the cost of borrowing goes up really high. You have to pay more interest on your debt and everything. You can't grow as quickly. That really slows down these companies' growth. And sorry, this is the last thing. Catalyst. So it's not enough for a company to be undervalued in your view, right? Even if you think this stock is worth $10 and it's trading at $2, you can go tell the entire world, right? But not most people, maybe one or two people will believe you if you post it on Wall Street Bets on Reddit with some semi-coherent logic. But for the most part, nothing's going to really change that stock price. So you need something to catalyze that reaction. These are called catalysts. So, for example, the Inflation Reduction Act was a huge catalyst for these clean tech stocks. This is the funding under current policy before the Inflation Reduction Act, going up till 2035. You can see the light blue is with the Inflation Reduction Act, how much additional spending is going to be projected for the energy transition and related activities. So another current example is nuclear technology. For a long time, people have been saying nuclear is the way of the future. We need nuclear. It's a really good baseload power generation, blah, 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 blah. No one's really listening. People are policy's not really moving. People aren't that excited about it. And then the second AI happens and we realize, oh, wow, we really need a lot of power now. Nuclear has kind of been incredibly bull run currently as well.
I guess one thing to add here, go back is, it might sound like a truism, but remember, the stock market at the end of the day is still a market, right? But supply and demand drive fundamental prices, and the value of any company is going to be the value that someone's going to pay for it. So even if your thesis is right, and the horizon to which it'll result in return, it really much depends on what the rest of the street, right, what the rest of the market thinks of the stock. So it's as much about the company fundamentals as it is about a game of expectations.
Yeah. So what Sid has been talking about so far is something called fundamental analysis. And that means that you analyze a company based on how good its business model is, like how good are its customer acquisition costs, and basically how you look at a stock based on the stock as a business. But there's also this other side of finance called technical analysis. And technical analysis involves only forecasting of future stock price movements, irrelevant of how the underlying business is doing. Instead, you would just look at the price and volume of the data. And you might see this a lot on if you go on Instagram. Like a lot of the day trading programs use something called technical analysis. And that means looking out for these patterns, which hopefully would from which you could infer future price movements. And although it sounds kind of ridiculous, and most academic literature kind of disproves this, there's some arguments for why it could work. One being market psychology. So these charts do somewhat capture underlying market psychology. For example, if a stock is hitting sort of a resistance point, a lot of investors might think, oh, it won't ever go above or below this, and then they might trade based on that. Or some argue it's also a self-fulfilling prophecy. Or if enough people, if enough technical analysis people follow this, then their selling and buying patterns do end up driving the movements that they predict happen. But
and just one other note, back in the day when markets used to be way slower and there wasn't this really high frequency trading and ETFs and all these fancy products, maybe there was more merit to this idea where like, people would go and buy at the beginning of the day or at the end of the day they'd sell or something like that. There's those patterns. And you can still exploit some of those patterns today, like the ETFs, maybe they settle every first of the month or third of the month. So yeah, but generally this is kind of like a astrology-esque trading idea.
Okay, now we're gonna talk about activism. I think personally, one of the more interesting hedge fund strategies. So what are activist investors? So activist hedge funds accumulate sizable stakes in public companies to try and persuade boards and management teams to enact certain changes that they believe will drive up the stock's price. Note the quotation around sizable stakes and persuade.
And also just one last thing, when we typically think of activism, we think of like, oh, promoting like, I don't know, good values or ESG. That is not the same activism in this case. But I'll let Jason.
Yeah, this is a type of hedge fund strategy that's focused on equity, which is why it's in the equity slide. So on the right here, you'll see some examples of what activist investors have done. They've been involved in fights with Disney, with Apple, and with Microsoft. So activist hedge funds really target the biggest companies in the world. So what are the characteristics of an activist? You have 5 things here. You have a long investment horizon, because it takes a long time for after they go into a board to convince the management to enact their changes and for the changes to actually result in an appreciation of price. You have something else which we call a deep value focus. So activist investors really prioritize finding undervalued value stocks, not growth. They also have something called high net exposure. So if you recall from the hedge fund slide, I think George and Sid probably talked about what exposure is, which is like how much percentage of your portfolio is long versus short. So if you're an activist, you're pretty much only going long a company. So most of your portfolio will be long, so you have like very high net exposure. You also have very concentrated portfolios. So you won't be investing in like 100 or 200 stocks. You'll really have a portfolio of 10 to 20 stocks, which you'll really focus on improvement on a day-to-day basis. And then finally, there's a lot of public advocacy involved. We'll get into why in a little bit, but it's often because you kind of have to pressure management a little bit to follow what you think should be done.
And just one quick thing, high net exposure is true for most companies or most activist investors, but like, for example, Hindenburg Research, I don't know if you guys know the story of Hindenburg, is the big blimp that blew up and burned. Hindenburg Research is a short activist investor. So what they'll do is they'll try and find frauds in companies and develop a short position in the company, and then they'll post all their research online and say, hey guys, look, this company's really bad, and then try and profit when everyone realizes that it is a bad company.
Like named after the.
Yeah, about the
Assume so.
disaster.
That's kind of crazy.
That's a cool name.
There's another one like Blue Dolphin or
Blue Orca.
Oh, we work with reading that.
Blue Orca is also
We're
an.
reading their like short manifesto on this.
Okay, yeah. So you'll come across the research sometimes. We've seen it twice in TSIG where someone will pitch a stock, and if you Google it and search like stocks research, Hindenburg Research might come up and have like a huge document exposing some fraud in the company. And a lot of people take it with a grain of salt because they're like, oh, they're clearly just trying to profit from everyone overreacting. Sometimes they're very true, and sometimes there is real fraud happening in these companies.
Yeah, I guess the best way to think of like what an activist investor is, it's they're kind of a mix of the private equity and a typical hedge fund strategy. So private equity firm will really focus on influencing companies and catalyzing changes over many years, which is what a lot of hedge fund activists do. But then they also adopt sort of a hedge fund, like a typical hedge fund strategy of targeting misunderstood assets and then profiting when the rest of the market catches up to what they believe the company should fundamentally be priced at. Yeah, a quick corporate finance reminder, just focus on the 2 things at the very bottom. So return of assets is net income over the company's total assets, whereas return on equity is net income over the shareholder equity portion of the capital stack. Just a quick thing for this next one, because there's different flavors of activism that can be typically broken down in these 3 dimensions. So you have the method of the value of the activist, you have the approach of the activist, and you have the size of the company they target. So the main differentiator of activist investor is whether they kind of take on an operational approach or financial approach. So as the name suggests, if you're an operational activist, you'll really focus on increasing the return on assets of the company. This is primarily by improving the business operationally, restructuring it, or even asking for a change of leadership. And I kind of like to think of this as like the consulting-like approach of an activist investor. On the other hand, you have financial activists, which are focused on increasing the return on equity. So reducing increasing the amount of financial leverage the company has, and thus you are able to attribute that same net income portion to an even smaller shareholder equity portion. So if you're a shareholder, you'll get more of that net income slice. And they do this by encouraging capital to be returned to shareholders through dividends, share buybacks, and like things like spin-offs. Second is something called the approach. This is like, how does the activist investor approach the current management? You can either do so in a friendly way by trying to work alongside the management. And this is often where most activist investors try to start off from, because it's a lot cheaper than if you have to use the latter approach, which is the aggressive approach. But sometimes if the management doesn't want to listen, then they pivot to being more aggressive, in where these activist investors will start demanding board seats so they can actually push through votes in the company. They might engage in public campaigns to convince other shareholders to vote alongside them. And they'll usually push for things like pay for performance management or pay for performance compensation, where you'll pay management more if you do well. And the final small distinction is like the size of the company they're targeting. So if an activist investor is targeting like a small to mid cap, they typically seek higher upside through more transformative changes by taking higher ownership stakes. Whereas if you're targeting like one of the massive companies that we saw before, like Apple or something like that, you'll typically focus more on just unlocking shareholder value through refining how the capital in the business is allocated. And of course, since the company's a lot bigger, your ownership stake won't be as high. So here are a couple of case studies of like real activist investor battles.
Yeah.
And so the first one is like in 2014, Carl Icahn took a stake in eBay and pushed for a PayPal spinoff, arguing it was undervalued. When eBay resisted, Icahn escalated with public letters and proxy battle threats until eBay eventually agreed to be sold.
Just pause for a minute. Does anyone know what we mean by a spin-off and reasons why you might want to do a spin-off?
Please probably explain.
Yeah, so remember, the price or the value of a company is always what people rather the market is worth. So when you have two companies, let's say company A, company B, when company B is part of company A, maybe company B is very high quality. It should be worth a lot more than what the entire corporation is trading at. One of the ways that you could catalyze or activate that hidden value is to separate the two entities so that all of their true values should be marked to market. That's the reasons for doing a spin-off.
And do people understand the concept of like why issuing dividends and buyback would actually increase shareholder value? So I mean, dividends is pretty clear, right? You're issuing direct cash to stakeholders. If I own $100 in a company and they issue like 1% dividend yield, I'm getting $1 every year from that company. So that's clearly just a cash transfer from the company's retained earnings to the shareholder. Buybacks are a little more complicated, but essentially, if you have a fixed pie of $100 or $1,000 and you have 1,000 shares in that pie, and you slowly reduce the denominator, the average value per share in that company will start to increase. And one last thing, do you guys want to talk about like sale leasebacks stuff? I think it could be important to show like ROE. That you want to do the job for it. Sale leasebacks. Yeah, basics. Huh? Yeah. You want to? Okay. Okay, let's think of go to the Kohl's graph first. Yeah, okay. So Kohl's has everyone heard of Kohl's? Like they're a big box retailer kind of thing. They were subject to a huge activist battle. You can kind of see all the events on this graph that Jason put together. But the goal of activist investors, especially the CFO activist investors, is to take companies that are capitally inefficient. Remember, we talked about the weighted average cost of capital and how the goal is to kind of minimize that. For companies that are inefficient in their capital structure, where they have like a lot of junk assets or assets that aren't producing tangible shareholder value, the goal is to kind of get rid of those assets slowly. And as George had mentioned, a spinoff is one of them. If you're Toyota and you own a paint company, yeah, maybe that paint company is profitable, but is that really adding value when someone buys a share in Toyota? They're not trying to buy part of a paint company as well, right? So an ideal there would be for an active investor to take a huge stake and slowly get rid of that paint company either through a corporate spinoff. And in the case of Kohl's, you might think that Kohl's, like, let's say they operate 10 stores, or let's just go with 3 for this example, and each of the stores is worth like $2 million. So let's say these are all the assets in the company, that gives you $6 million in assets. If Kohl's owns these assets outright, they actually own the real estate, they have $6 million tied up in real estate, right? That's not necessarily the most capital efficient, because now when you talk about return on assets, you have some, like, let's say net income over your assets. So if you want to try and increase your ROA, you can either increase your income, which is obviously the goal of any company, is to become more profitable, or reduce assets, right? So what a sale and leaseback is you take these $6 million worth of real estate and you sell it to someone. Let's say I'm Kohl's, I own these $6 million worth of real estate, these 3 stores, and Jason is some real estate investor, maybe like they like to buy corporate real estate. I sell $6 million worth of real estate to him, and I end up leasing the property back to him. So now instead of having $6 million on my balance sheet, I'm just paying a lease payment to him, and that makes me more efficient in the eyes of shareholders. And that's the idea of like how you can increase return on assets just by reducing your asset size. And similarly for return on equity, if you can reduce the number of assets you have, you can boost your return on equity, and that's what activist investors kind of look for. I think that's probably it. Anything else?
I guess when I said that operational activists focus on increasing return on equity, note that this asset, this denominator, is hard to change. It's hard to move around, which is why if you're focused on increasing return on assets, you mostly focus on increasing this net income, like these operational changes. On the other hand, if you're a financial activist, this is return on equity, and instead of assets, it's shareholder equity.
Yeah.
This is much more malleable to change because you can move things on your balance sheet from the equity portion to like the liability or asset portion. So, which is why, financial activists can also focus on improving this and not just the income or the operating of the business.
And the ways to reduce shareholders' equity, by the way, are those dividends and buybacks. When you send money back to capital or back to your shareholders, you're reducing on the assets and liability sheet. You take away some cash or retained earnings, you take away some cash, and you also take away some of the shareholders' equity. Everything balances out. Same thing through your dividends.
So a quick test. So just a brief summary. If I'm Paul Icahn and I'm pushing for eBay to spin off PayPal, and I'm doing so through like public letters and proxy battles, do you guys think this is like operational or financial activism? Yeah, it's financial and it's aggressive because they're doing so through like public letters and proxy battles. On the other hand, for the second example, if I'm Bill Ackman and I invest in Chipotle after some food safety issues, yeah, and I'm privately suggesting leadership changes, I'm privately suggesting strategies to restore trust and stabilize the business. Am I doing operational or financial activism, and am I doing it in a friendly or aggressive way? Yeah, that's true. So something you'll find out noticing is there tends to be somewhat of a correlation between some of the dimensions of a company, of an activist investor. So if you're an activist investor and you're a financial activist, you're more likely to be aggressive than to be friendly, because a lot of the times management is not just going to want to release out a bunch of dividends. It's not going to want to push out a lot of buybacks. And the reason for this is the more capital that management can keep within a business, the more power they have, technically, because they control more things. So they're not going to want to do that. So you kind of have to take a more aggressive approach.
And remember, you might be thinking like, what's the point of having like a publicly traded company if it's mismanaged? In the case of like what we learned this summer, in the case of Japanese equities, a lot of these investors are very risk averse, right? Especially when you have negative interest rates. Putting money in the bank makes you lose money, right? You're having negative interest rates. So a lot of these people would much rather just put their money in some stock, and they don't really care what happens because as long as they're not losing money, it's better than putting it in the bank account. And so what ended up happening in Japan a lot, and this is like the case of the third case study, you actually need activist investors. A lot of these companies in Japan actually have like negative enterprise values, which means they have so much cash on their balance sheet that, the enterprise value formula, equity value plus debt minus cash, that minus cash becomes so large that you actually have negative enterprise value. And so you need activist investors in this case to kind of get that cash off of the company's balance sheets and back to the shareholders, which is what buying a stock is for, what corporate governance structures are for. And so some people argue that they actually make markets, more efficient and they're better for all participants in a market.
And one final thing about, which is why the third case study is there, about that geographic distinction. In countries like the UK or the US, where the culture is very pro-shareholder, most activist investors will be aggressive and will be financial. However, in countries like Japan, where the culture is that the company management itself has a lot of power relative to shareholders, activist investors actually have to adapt a more friendly approach. So for example, when we were looking at a bunch of Japanese activist investors over the summer, a lot of them explicitly say in their fund profile that they are friendly and they're operational, for instance. This is a Taiyo, one of the biggest ones. So what I meant to show by this real quickly is that an activist battle is, it's not an easy thing. You don't just go into the company, they don't just listen to you, even if you have good ideas. It involves like many twists and turns, as you can see here. So in the case of Kohl's, they were taken over by, I think, a coalition of several activist investors. And over the course of the next 2 years, they kept trying to push the Kohl's to sell its business to acquirers. But eventually, Kohl's managed to win against activists, and then their share price, so Peter. Yeah.
What is a poison pill?
Yeah, a poison pill is like it's a defense strategy that makes it harder for like external shareholders to have voting rights, especially if you're new. So it gives more power to like existing ones.
It's like a legal thing because the whole idea is if you can buy enough percentage of a company, you can vote on their bills, right? So this is like a corporate defense tactic where like you hire a bunch of expensive lawyers and investment bankers, and they tell you how to like engineer your votes so that the activists don't get any votes and you get to hold your business.
Now, when it gets really heated, there's also kind of a lose-lose situation where the management will actually try to dilute out the entire shareholder base just to make it more difficult for the activists to get, proper board seats.
They're very controversial because a lot of people say like they're just very aggressive sometimes.
The dilution really mean you now own less of the company than you used to?
Yeah.
Or rather basis, yes.
When you issue shares, right? If you come in this with $100 with 100 shares, and suddenly that 100 shares becomes 1,000 shares, now your one share is worth a smaller percentage of the pie of the $100.
Why is that really influencing investors?
Because sometimes you have to issue shares to raise capital, right? It's the you remember how we talked about you can issue debt, you can issue equity. So companies like when they IPO, they issue equity to get access to more capital.
But they're not issuing equity, they're just like taking equity from their investors, getting it to them.
But the math doesn't work out like that. We won't get into too much of the nitty-gritty there.
Yeah, just think of it like why we print money.
Yeah,
Like, you want to print money, but you don't want to print that much money because that devalues
Yeah,
it.
I guess it is.
yeah.
Okay, so the main thing is like you might be thinking, so how big are these stakes? Well, as you can see in these very large companies, they're very small, they're like less than 1%. But companies still care because even with a small stake, you can have a lot of disruption potential. And especially in these companies with really fragmented ownership, 1%, you might be like the second or third largest shareholder. And the final thing is that a lot of the times, activist investors target failing companies so that the investors are more willing to hear like a second opinion of what can be done better. And activist investors, they're pretty successful. If you just buy the companies which activist investors are targeting, you'll beat the S&P 500. And this is even without getting the little jump here. Like typically when an activist investor announces that they acquired a stake in a company, there's like a little jump in the stock price. So this market beating return is like even excluding that factor. And like the craziest thing about an activist investor strategy is that even when you lose, like for example, Nelson Peltz lost the Disney fight, he still made like $300 million because by battling Disney, he kind of forced Disney to like release a slew of renovations or plans of what they want to do next, and that kind of drove up this.
If you can't tell, Jason absolutely loves activist investors. I think it's like his dream job is to work there. Let's keep going. We got that.
Okay, so very quickly, what's the efficient market hypothesis? It states that asset prices are always perfectly valued, and because of this, it's impossible to consistently outperform the market through stock timing or stock picking. And really, there's three main forms of this. There's the weak, semi-strong, and strong form. The weak form says that current prices reflect all historical information. And if you remember what technical analysis means, it means that if the weak form is true, you can't do technical analysis. The semi-strong form means it includes all historical prices, like all publicly available information, meaning that no amount of fundamental analysis can generate consistent market beating returns. And the final form is the strongest form, which states that current prices reflect all public and privately available information, meaning that you can't even beat the market consistently, even if you have insider information. And this is kind of like a generally accepted thing in academia that kind of started around the 1960s in University of Chicago.
Yeah. Yeah, okay. So now obviously investing is very lucrative, but as we've shown you, it's quite hard to get it right. Lots of brilliant minds have thought about what's the right way to do it. And if you do believe in the efficient market hypothesis, right, then you kind of have to listen to John Bogle, Princeton class of 51. You might have heard of Vanguard or BlackRock. These are the behemoths of finance that have trillions of assets under management. And what they do for the investors is, okay, if stock picking doesn't really give me any superior returns, right? What if I just own the market, right? If I just bought the S&P 500, I'm clipping in, 8% annually compound, and that's pretty good returns. Some people in academia, including Bogle and a whole slew of Nobel Prize winning economists from the Chicago School, would have you believe that this is the right way to do it. And the reasons are pretty, you can do a derivation for it, but they reason that through owning the whole market, right? Really diversifying across different assets and stocks. You diversify away all the idiosyncratic risk in each individual stock. If you don't have idiosyncratic risk, you should not be compensated, right? So then you end up earning the market return. And so, is that what you have here in the graph?
Inflows to passive.
Oh yeah, and so in recent years, what we've seen is, quote unquote passive management. And what we mean by passive is just these indices that own the entire market. They've become much more popular, and the money has been flowing out of traditionally actively managed funds into these passive funds.
Yeah, so most people don't believe in like the strong form. Most people think that if you are insider trade, you can beat the market. And as the graph suggests, insider traders time their sales and purchases to kind of beat the market. This is kind of what the graph is showing. So the strong form probably isn't true. Example is Stack Capital. It's a hedge fund that averaged 30% annual returns net of fees for 20 years. People are like, well, how do they do this? Well, turns out they had been doing insider trading. The fund got shut down, but now they're called 0.72. And a lot of you guys probably might want to work in the future. So, don't let insider trading or like the Fed stop you, or SEC stop you. I can't say that. Okay, so a lot of people do believe in something called the semi-strong form, which is that you can't beat the market through technical fundamental analysis. But if you actually look at this graph, it shows that when a stock is announced to be added to the S&P 500, on the day that it's actually announced, it'll exhibit an additional abnormal return. If you believe in semi-strong form, this increased abnormal return on the day that it's actually added should be priced in, but it's not. The reason for this is because ETFs that track indices are forced to hold some of these stocks, so there's like an additional liquidity premium. There's also something called price drift. So after a stock announces an earnings surprise, either they beat expectations or they fall to expectations, the price does not instantaneously change to the new price, which is what the semi-strong efficient market would suggest. Instead, after it increases, it'll continue to increase in that same direction. Some explanations for this is because investors might not actually be paying attention to this, or momentum traders might be causing the prices to overreact. Well, a lot of people say, okay, maybe the strong or the semi-strong form is not true, but surely the weak form of the efficient market hypothesis is true. Well, a lot of hedge funds actually exploit inefficiencies in even the weak form of the efficient market. AQR is very famous for its momentum strategy, which we'll talk about shortly. There's something called block trading, which somebody called Michael Steinhardt did. And there's also, statistical and arbitrage high frequency trading. We're running out of time a little bit, so I'll kind of move through these quickly. But Princeton teaches a course on this, so it's pretty legit.
Yeah, so a bit more on, I guess, academia versus reality, what the professors will have you believe versus what people are doing in the market. So, right, we've kind of talked about timing the market already, and there are very of thought here. A very, very influential book in investing literature is Random Walk Down Wall Street, right? And as the name suggests, they have a view that stock price movements tend to exhibit characteristics are of random walk. So, that would make you believe, trying to time the market would not be very fruitful over a long enough time horizon. And this kind of thinking in academia has really, has won more than one Nobel Prize. But is it actually true? Well, obviously in the real world, right? Stock price movements are not a true random model, but the model is kind of right in many sense. But what we should think about, however, is the more nuanced to this model. And there's a very famous dictum that claims markets are micro efficient, but macro inefficient. And there's so many ways to interpret that we don't have time to unpack it fully. But if you just look at individual stocks, right? And Jason showed, like there is some drift around earnings prices, but over time they tend to move very quickly, and everything gets priced in efficiently, very, to some extent. But if you look at the market as a whole over a long enough time horizon, there are structural inefficiencies that hedge funds have been exploited. Otherwise, the whole investment, management industry just would not exist at all. On a macro level, there are some evidence to suggest that factor timing could be helpful, and we know from personal work experience that there are hedge funds out there that consider it an edge, to be able to time or tilt their portfolios towards certain factors or asset classes depending on market conditions. And lastly, you'll see this phrase tactical allocation pop up a lot. It's probably something it's generally along the similar ideas, like the fact that okay, maybe I can't always pick the right stock at the right time, buy low, sell high like the short sellers. There are some merits to maybe tilting my portfolio. Again, none of these are definitively right or wrong, which leads us to another topic, right? And yes, I guess the professors, the really, really smart Nobel Prize winning guys are kind of right in that, whatever flavor of emission market hypothesis you want to believe, the reality is market beating returns are not very sustainable. And that's a fundamental fact. If you could point your attention to the graphs on the right, this is a paper that sorted, hedge fund returns in the present, right? Consider time period 1, and then plotted their returns in the subsequent periods. And you'll see that, the outperformance in the present are not necessarily going to be outperformance in the future as well. So if you look at any hedge fund document, they'll, put up a very big disclaimer that past performance is not indicative of future returns. Just keep that in mind. And the fact that most hedge funds don't have sustainable alpha is kind of evidence to support efficient markets in a more general and less I guess strict sense. And lastly, we need to talk about diversification, right? As the idiom goes, don't put all your eggs in one basket. So why is it that I've got 3 Nobel Prize winning economists here? Why are they all saying that, like John Bogle and all your, big ETF managers, that the best way for investors to invest is to own the market, right? There are so many different ideas along the same lines, like portfolio separation theorem, for instance. They think that the best way to invest would be for investors to constantly rebalance their investments between something risk-free, like bonds or US Treasuries, and the whole, tangency portfolio, or whatever the market is in some sense. And well, the reason is they're not exactly wrong. For your average investor, your average worker, they're probably better off just holding the index. And because as we've showed you in the last slide, even the hedge fund managers probably don't really know what they're doing most of the time and don't have persistent alpha, right? But what is true is, the efficient market hypothesis is a hypothesis, right? So it holds to some extent, but there will always be exceptions. And there's probably no more famous exception than Warren Buffett. Buffett's investment fund has, averaged a Sharpe ratio of 0.7, which is significantly higher than the market performance of around 0.5 at the highest. So are the people in academia wrong? Not exactly, but they give us a pretty useful framework for thinking about what does it actually mean to beat the market, right? So on the right, we have some research findings from AQR, and we've talked about them a lot because the founder of AQR is probably one, again, he follows in the tradition of the Chicago School. So these guys on the left, right? But he famously departs from his mentors in the sense that he doesn't believe in the efficient market hypothesis fully. And so he did some research into why Warren Buffett is very successful. And if you just compare, his returns against the risks he's taking in the traditional sense from your, Kaplan model that we talked about last time, he's a genius, right? And he certainly is considered by many people. But if you begin to factor in other risk factors, right, and taking into account other factors that we've talked about, then Warren Buffett's success can be attributed, and it's not so outrageous, and it's compatible with Ethereum. So yeah. Jason, please.
Yeah, so we talk all about efficient markets, but whether or not you believe it or whether or not you don't, there's sort of like a pendulum swing between active strategies and passive strategies dominate. So because if you completely believe in efficient markets, there's like no point of you kind of going into the buy side, especially public investing buy side. However, what we'll actually find is that if there's a lot of active strategies, then there'll be a lot of competition in the market, meaning that the post-fee performance of all these active management kind of drops. And what happens is that if you don't perform well, capital will leave you, and instead the active managers will shut down and they'll go into passive management. However, there's so many passive management strategies, there's not enough rational investors to kind of, get all the alpha out of the market where it exists. And what ends up happening is that the few active managers that remain start dominating, they perform very well. And because of this, capital starts flowing into the business and new active managers come in to try and emulate this. So there's sort of like a pendulum swing between active and passive managers.
Yeah. Okay, and now really quickly to discuss factors. So the factors are often referred to as smart beta. So if you remember, we just discussed this in the beginning, but beta is your exposure to the general market. Smart beta refers to beta specific market factors when you want to be exposed to these factors. So for example, as we just some investors prefer to diversify all of their idiosyncratic risk, right? They'd rather just have no risk to any one company. They'd rather just own the market, but others prefer to have it. They have a directional view on what should happen in the market. And these are all just variations of risk preferences and investment styles. The Yale endowment model, for example, is very famous because he took Yale's endowment and invested into a lot of alternative investments, such as hedge funds and private equity. And he took a lot of this idiosyncratic risk on new managers. And a lot of people said he was wrong back then, but I mean, now he's won a lot of awards for his performance. So factors perform differently in different markets. So you can think of a size factor as maybe like 20% of going long 25% of firms with the smallest market cap and short 20% with the highest market cap. Value factor might be going long 20% of firms with the lowest price to book ratio and going short 20% of the firms with the highest PB ratio. And so you can kind of create these general factors, and the rule of what is considered a factor is something that's easily replicable, right? There's no human intuition. You can kind of code it into a machine and the machine can execute that strategy. And so in a bear market, which we saw in like 2020, for example, you can look at, or I guess this was before the pandemic, but you can look at the performance of these different factors. And you can see like, okay, like quality did pretty well here, momentum did pretty well here, but value might not have done so well. And so you can quantify your factors, so I guess the goal of a factor process is, if you think about the business cycle, you have a bull market, a recession, a bull market, a recession. Maybe during a bull market, those growth strategies, those ARK innovation ETF stocks that we just talked about, the Teslas, the Coinbase, they're going to do very well. And we saw that, right, in the ARK innovation ETF. They did very well when they do well. But then maybe as we move to a recession and the Fed starts hiking rates, as they did in 2022, those growth stocks start to collapse, which they did. And maybe now value stocks are more profitable, right? So you can kind of shift your portfolio and allocate to these different factors as the market moves. So it's between index pure passive management and between that and alpha, which is like managers and pure human intuition. So factor models try and give slight discretion to the different exposures in the market. And any fund will sometimes report their exposure to these factors. So common ones are value, market cap, so size, are you primarily exposed to smaller companies or larger companies? Momentum, so has your stock been going up for the past year, 6 months, whatever. And of course, there's a lot of variation how you can define these, right? What I consider momentum might not be what Jason considers momentum. What I consider a value stock might be a PE under 25, maybe he considers a PE under 12, right? So there's a lot of room in what you can consider as correlation to these factors. But generally, you're trying to figure out how much is my portfolio exposed to this certain factor. And I guess if you think about different investing styles, like Buffett might be really exposed to deep value. T-SIG might be very exposed if you can create an energy transition factor, or probably like a super levered bet on that energy transition factor. And so you can try and diversify all of these factors away as well. And there's some funds that actually aim to be factor neutral. The last thing is, if you remember from last week, we talked about how you can evaluate a fund, right? There's two attributes, return and risk, volatility, and the mean return mu. And if you plot them on a graph, they might show up in different spaces, right? Credit is typically low return, but also low risk. Equities are higher risk, but better return, and maybe PE and VC are up there in the top right. And the way you can compare different funds, so if I gave you a fund with 5% return and 5% volatility versus the market with 10% return and 20% volatility, how can you compare those two investments, right? When it's strictly to the top left, when you have a higher return and lower volatility, you know that that's a better investment, right? You're getting more, for every unit of risk you take on, you're getting a higher return. And the reason that this is important is because you can imagine that if I give you a fund with 5% and 5%, maybe I should write these numbers. So you have hedge fund A, right? And let's say that is 5% return, well, mu, sigma squared, and let's say 5% volatility versus the market, which is 10% returns with 20% volatility. How can you compare this, right? Because this has a higher return, but it also has a higher volatility. And so this motivates the Sharpe ratio. And so the idea is if I took out a loan and I doubled my exposure to this hedge fund, right? So now I'm getting, if you remember basic statistics, you're getting 10% return and you're getting 10% volatility. I mean, I guess it's not actually statistics because you square it, but whatever. Roughly, you're getting double the return and less volatility. You can clearly see that investing in this hedge fund, even if you levered into that hedge fund at a 2x lever ratio, you're going to be doing better. So the goal is, and then the reason you have that risk-free rate in there is because you have to pay some cost for this leverage facility, right? When you take out a loan, you have to pay an interest rate. If you're levering into a hedge fund, you have to pay that interest rate. And that's why that is the y-intercept on this graph. So it's not zero, but at the risk-free rate, which is usually a T-bill, you can draw a line through your company that you're trying to evaluate. Anything that's on that line is the same Sharpe ratio. Anything that's above that line is generally better, and below is generally worse. And so that's the way you can compare two different return streams. Maybe you have one fund that's very like factor neutral, market neutral, has very low volatility, and something that's maybe like Arcane Innovation ETF, which is like really risky, but could also be really high return. And as always, Tiger Investments open education session and materials here. Next week is we forgot it's election day. When we were making the calendar, we won't be having an election. Not an election. We will be having an election. I hope you guys all vote, but we won't be having a lecture. And we'll see you the following week, and we'll just push everything back 1 week. We had a bit of buffer anyways. Yeah, please fill out the survey. I always ask, and not all of you guys do it, so please do it. Are there any questions too, by the way? And did anyone think of any ideas for the last lecture that they want us to go over? You guys want us to go over accounting in more detail? Anything else that's on your mind? Yeah, put it in the form too. Next week will be private equity, structured products, and debt strategy. And that's one of my favorite topics too, because I think mortgage-backed securities are one of the best inventions of human kind. Maybe after the week, but yeah.
Like next week, we got.
Sorry, yeah, next lecture, 2 weeks. Cool. Thank you guys.
Thank you for coming.